afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and try to analyze the market environment and see what type of trading environment we are in. If you like what you see, you can always follow me on Twitter at Stock Darts, or you can find videos of mine on YouTube under the same name. Or the best choice is probably to visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas and watch list ideas, and generally just expanding on whatever information we come across during these Wednesday market reviews. And you'll also find the copies or the recordings of these Wednesday market reviews as well. So that's typically the best place to go if you want to see more content, if you like the way I analyze charts. Like I said, what we tend to do here is we go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000, and get a gauge on exactly what the market's doing right now. And then from there, we try to figure out what kind of trades succeed during that type of environment. We're also going to take a quick look at the U.S. dollar. We're going to look at oil, gold, silver, and Bitcoin and Ethereum as well. See if there's anything moving or shaking in different areas that aren't necessarily correlated to the overall U.S. stock market. For those of you that maybe are new or watching this for the first time, I tend to use a lot of technical analysis, and I feel like that's something that can be applied to more than just the U.S. stock market. That's part of the reason I like to look at the Forex markets and the cryptocurrency markets as well. Is if you understand how to read a chart, you should be able to trade any instrument that is charted, which helps a lot of times when the market is giving you poor trading opportunities. You can go ahead and try to trade other vehicles and try to get your return that way. And that's something that we do a little bit on these streams, is try to highlight opportunities that may be arising in different areas if the market is not cooperating, or if, so for instance, if cryptocurrencies, which are now starting to make strong moves, it makes sense to pay attention to them. And as long as you understand technical analysis, you should be able to benefit from that. But let's go ahead and get started with the first thing we're going to do, which is, of course, take a look at the S&P 500. And we're going to do that through the ETF SPY. And as you can see, things are looking pretty good. You're going to see a little bit of a mixed bag as we go ahead and take a look at the four major market indices, with a couple of them, the S&P 500 and the Dow, kind of pushing up to new highs, and then the NASDAQ stalling out a bit, and the small caps of IWM, really the only index that's behaving kind of poorly right now. I think generally speaking, we are in a market that's rotating back and forth, and the market indices are just kind of holding steady. While we see capital kind of rotate back and forth, and we see different areas of the market take turns trying to take over the leadership mantle and push upwards. And I think that's the real story right now, is not necessarily what the overall markets are doing, but more along the lines of what can we capture underneath the hood as we look at what areas of the markets start to do better or do worse, and take turns. And we'll get into that, and we'll dive in a little bit deeper as we get to the other indices. But for now, let's take a look at the S&P 500 in a vacuum, and just assume we're looking at a chart of just a random stock, or just the one chart of the markets. And like I said, the big thing here is we are actually pushing to new all-time highs today. We're going to zoom in a little just to point it out. You can see exactly what's been going on. If we really, since the springtime, we've had two pretty decent areas of consolidation, or periods of consolidation, and yet the overall trajectory of the market has remained upwards. And I think that that's important. To zoom out for a second, I want to highlight exactly how long we've been trading in this channel that's been just going up in a nice steady 45 degree angle. And you can see we started this rally way back in November of last year, right around the beginning of the holiday season, and the markets have pretty steadily climbed along this trajectory for quite a while now. We're looking at more than half a year of a steady, uninterrupted climb. Now, part of the reason it's been able to do this is because in between and within this channel, we have actually had three pretty good periods of consolidation that have allowed the market conditions to become less overbought and have more of the normal buy and sell cycle, where traders could take profits and new traders could come in and take over and continue to hold, trying to get further profit as it goes upwards. And that's exactly what's happened on two to three occasions already. You can see back in February and March, we traded sideways, and we actually threatened a breakdown. We had this broadening wedge. We kind of came down, and at this point it looked like maybe we were kind of done rallying, but the bulls came in and saved the day, and we kept pushing upwards. And then we had the most extended period of consolidation that we've had this year, which was back in April and May, and actually bled all the way into the middle of June. And this stair-stepping nature, is, like I said, is what's allowed this trend to continue as long as it has. And we had another small consolidation range that just began back in July. And as we zoom back into what we were looking at a minute ago, you can see that we've actually broken above that, and we had a nice little period of consolidation. This is usually the quiet before the storm. Typically, when you're looking for a strong breakout, you want to have a nice, very tight consolidation at the top of a range. In this case, it's actually above the range, and now we're starting to bleed out above it. And so, overall, this is all a very bullish chart. And if we were just looking at the S&P 500 and not at the other three indices, we would say that this market is poised for a strong breakout. Now, the only real negative that we could draw as far as the S&P 500 is concerned is that we haven't actually broken out. If you go ahead and you take a look at how long we've spent above this last period of consolidation, you can see the highs that we printed back in the middle of July, around 437. We've been holding above that, but we haven't had enough pressure to really push upwards. And as you can see, volume is starting to decline as we kind of drift upwards. And that's typically not what you want to see when you're looking for a breakout. You want to see volume increase as we start to break out. Now, this isn't enough to really indict this as a false move or to get worried about a breakdown following this, but it is the first. It is a little bit of a warning signal that we haven't been able to really push through. Now, it could be that we get a breakout in this afternoon or tomorrow and start to really rally. And like I said, everything right now is indicative of a strong market that's in the middle of a rally. So the big key takeaway here is for those traders that maybe are a little nervous and feel like the market shouldn't be up here, try to ignore that and just go ahead and take advantage of this momentum. Now, the one thing I will point out is, and it's been a little bit difficult over the last couple of weeks to find good trading opportunities because of this, is you don't want to chase the price action. You want to make sure that you are buying stocks that are either emerging from tight periods of consolidation like the market is doing, or stocks that have already consolidated and pulled back and are holding closer to support and give you better risk reward. The last thing you want to do, and this actually applies to the market, which is why I wouldn't necessarily want to buy the SPY today, is you don't want to buy something that's up 4 or 5 days in a row or 4 out of the last 5 or 6 days, as is the case with SPY. You can see that we started running up back here on August 3rd. You can see we've got 1, 2, 3, 4, 5, 6, 7 candles, of which 4 or 5 of them are green, which makes it a little bit more difficult to try to go ahead and buy this because the chances are we need to pull back a bit and come back and retest. Now, it may not happen. It might be that we just break out, but at this point, the risk reward's not that fantastic, at least as far as the S&P 500 is concerned. As like I said, if you go ahead and take a look at where we are, the first real stop we have, and it's not even that great of a stop, would be down here at 435. And while there isn't any real resistance that we could put up as our target, there's probably not that much room to the upside before the market goes ahead and tries to consolidate again. Because again, we're getting these mixed signals from the other indices, which we'll get to in a minute, which point to a market that's probably not going to have a strong breakout. Typically, when you have a market that breaks out in a very strong manner, you have all 4 of the indices, or at least 3 of the 4, moving together, and that's not really what we're seeing right now. We're seeing mixed action that tends to lead to what we're seeing right now, which is a slow drift up and down as we try to hold above certain key levels. Now, if you look at the moving averages, again, this is indicative of a strong rally. You have the 20-day moving average moving up, the 50 underneath it like train tracks, the 200 well below it, again, kind of running parallel. When you have all 3 moving averages running parallel to each other, that is telling you that the market, or that particular chart, has a pretty strong trend going, which means that more often than not, it's going to take a decent amount of price action to shift that trend. And so we can look at all of these moving averages as potential areas of support, and we can look at this channel as a potential area of support. And so even if we see some selling coming into the rest of this week or next week, more likely than not, it will be a buying opportunity as we come back and retest areas of support. And like I said, if we do break out, well, what we want to do is find stocks that are going to follow this and break out alongside the market, but are giving us better risk reward than what we're seeing on the S&P 500 right now. Now, let's take a look at a couple of the key levels we could analyze in case we do have a sell-off. There really isn't a key level, like I said, to the upside, because again, we are at fresh new all-time highs as we speak. At the moment, there is, unless someone bought the S&P 500 a few seconds ago, everyone that owns the S&P 500 is green, right? And so there is no potential selling area here other than traders that get nervous because the price gets too high. So we don't have any levels to really identify above us. However, below us we have a few key levels that we could really watch. Now, in the very, very short term, we have this previous highs that we just broke out from, which is right around 441. Now that is so close to price action that if we get some selling, it's very likely to break, and I would not consider that as an important level. However, just underneath that, we have a pretty decent level, and again, it's very close to the price action, but it would likely be the first line of defense for the bulls. If we weren't able to really extend this breakout, we'd have to come back and retest the top of this consolidation range as well as a 20-day moving average, which both happen to coincide right at the same level, which is right around the 438 level. And this would be our first real line of defense and our first real area for the bulls to test. And just below that would be the next test, which would be this ascending trend line and the 50-day moving average, which would come up to meet price, probably in a very similar area, assuming that we didn't just take one big red candle down to them. And so those are the two key levels we want to watch right now, is 438, and then just below that, whatever happens with the 50-day moving average in this channel as they come up to meet price. And so like I said, typically with a strong trending stock like this, or strong trending equity, the moving averages become pretty significant as far as the first level of potential support. And those are going to be the two areas that we really want to pay attention to. Now, further down below that, if for whatever reason the market really shifted character, which doesn't look like is going to be the case, at least in the near-time future, when you consider the fact that we've just gone through a pretty good earnings season, and I think we just had a Fed meeting recently, and so there's nothing out there, unless it's news that comes straight out of left field, to really impact the markets. We're really just trading off technicals right now. However, if there is news that comes out of left field, if for instance maybe we get more bad coronavirus news, then maybe we do have a strong sell-off. Well, after the moving averages, we have a very, very strong key support area here, right around 422 to 423, and I do not expect that to be breached anytime soon, and I would expect that to be a really good buying opportunity. Even if we lost this channel and we started to break out of this uptrend that we've had for a while, this would still be the area where you would expect the bulls to come in and defend. However, from here to next week, I really don't expect us to break below this channel, and certainly not below the 50-day moving average. More likely than not, what's going to end up happening is we just keep shifting back and forth right around these 440s as we either continue to break out or we fail this breakout and come back and retest the moving averages. But like I said, looking at the S&P 500, this is a very bullish chart, and there really is not anything overly negative you could say about the chart. Really, the only ding that I have on it as far as analyzing it is the fact that we're breaking out on declining volume. And that's not always the end of the world. As you can see, the last time we broke out on declining volume, we still continued to kind of meander upwards and then eventually consolidate. And so there's the case to be made that this is doing something very similar, and we're going to do the same thing where we drift up for a few more days and then maybe come back and test and then keep drifting sideways. And so generally speaking, this is still a pretty bullish chart, and I think more than anything tells us that we should be confident in finding trades in the market and not worrying about a market that's going to randomly turn around and drop on us. Now, that doesn't mean, of course, the market can't correct, but I imagine whatever correction we see in the next week or two is probably going to still be pretty benign and going to be just more run-of-the-mill pulling back rather than sharp moves down or a big change in trend. Now, in a little bit of a contrast to the S&P 500, if you take a look at the NASDAQ, you can see a little bit of a different picture, right? We're not at new all-time highs. As a matter of fact, we failed to break to new highs and have pulled back to our 20-day moving average. And so this, I think, is the first exhibit in the defense of a more sideways market, and the first real indictment on the potential for a rally in the future. Typically, you want all the moving averages moving together, and that's not what we're seeing here. Like I said, or typically you want all the indices moving together, and that's not what we're seeing here. We're seeing the NASDAQ pull back a little bit. Now, this could be indicative of just sector rotation. Tech stocks picked up a lot of momentum over the last month, and it could be that they just need to take a breather. I still think that tech is a good spot to be in, despite the fact that we're seeing them pull back a little bit. As we see more and more coronavirus spikes across the country, I think that we may have to go back into using more of these tech names, and maybe not necessarily quarantining like we did last year, but maybe starting to kind of stay home a little bit more, and take advantage again of working from home or shopping from home, using Amazon or Zoom or whatever. So I imagine the tech stocks will continue to kind of firm up here and start to outperform what we're seeing across the board. Now, that is not what we're seeing today, actually. What we're seeing is quite the opposite of that, where the NASDAQ is pulling back and the Dow Jones is starting to outperform, which will be indicative, again, of the recovery rally, and where you have more of the industrial type names doing better and the tech names doing more poorly. But I think that this is, at the moment, really just profit taking in tech names and value buying of some of those recovery names that maybe got hit kind of hard. We had like I said, we've had a very interesting year so far, and we've had a kind of this play between the two. It's almost like a seesaw, where tech names do well and then they do poorly, and the recovery names do well and then they kind of go back and forth. And I think what we're seeing right now is a little bit of a bounce on that seesaw, but I don't expect it to be a major one where tech names pull back significantly and the recovery names do better. I think that this is just a small blip, and I think tech names will again start to recover and start to outperform again. So generally speaking, that's where my mindset is at as far as tech stocks are concerned. I still think they are a good area to go ahead and trade, and one of the focuses that I have so far. Now, that being said, like I said, as far as today is concerned, as far as the short term is concerned, they clearly were not ready to break out on the NASDAQ, right? We're coming back, we're testing the 20-day moving average. We're still kind of stuck in a period of consolidation, and you can see we have this ascending triangle forming. And now the key is going to be, of course, what happens as we reach the apex of this triangle. We're coming up and testing the 20. If we fail this and come down and test the 50, I think that means that the S&P 500 is also going to pull back, and I think we're going to see all four of the indices pull back to support. So this is one of the things we want to watch, is how the NASDAQ navigates this ascending triangle pattern. If it can break out, then I think that bodes well for the S&P breakout and the Dow Jones breakout. And I think that it will kind of lead everything upwards, and we might actually get a good rally going as all three of the indices move together. However, if the tech names continue to slow down over the next week and actually break below the 20, break below this little trend line, and actually lose maybe the 364 to 362 support, then I think we're going to see a pullback across the board, and likely have to come down and test the 50-day. Now, like I said, when we were analyzing the S&P 500, when you have a stock or an equity that's trending strongly, the moving averages become good areas to test for support. And so there's a very good chance that if we do fail here at the 20, the 50 should hold and we should get a bounce. And so that's going to be a decent buying opportunity for those that like to buy the dip. Once we see confirmation of support, we can look to buy some bounce trades. Now, often what happens when you have a bounce between the 50 and the 20 is you're going to come down and hit the 50, then bounce up and test the 20, and then from there figure out whether you need to come back down or need to go back up. You can see this is exactly what happened back here. We broke down and tested the 50, bounced up, tested the 20, then came down and had to retest the 50 and actually break below it. And that happens more often than you would think as price action gets wedged between the two moving averages. And so that would be probably what we'd expect if we did continue to pull back here. Now, and like I said, if we break out, I expect the S&P 500 and the Dow to break out as well, and I expect us to get some good long trades going, as long as we respect our discipline, or as far as risk reward is concerned, and what kinds of trades we want to go ahead and enter. And like right now the Nasdaq, unlike the S&P 500, the Nasdaq's actually down 4 out of the last 5 days, or 3 out of 5, depending on what you want to call this candle on the 9th. And so it's coming down to support, and probably offers us a better buying opportunity once it kind of cleans up and gets back above this 368 level. But for now, it's just kind of stuck in consolidation, and we really want to see what it does. It'll give us a better hint as to what the rest of the markets do. And like I said, the key levels to watch are going to be right where it's at right now, around 364, the 50-day moving average around 355, and then finally, just like the S&P 500, we have a very critical level down here around 342 that I do not expect us to reach within the next few weeks. But whenever we do hit that level, I think that that's going to be a major support level, and one that we can expect the bulls to staunchly defend once price gets back over there and once we have to retest that. could be that when that happens, it might be that the 200-day moving average is already kind of run up past that or up to it. And so that might be another area that needs to be tested as well. But for now, we don't need to concern ourselves with that. Like I said, with no real news coming out to affect the markets, we're just kind of going off of technicals, which means we're probably going to retest this triangle for another day or two, and then see what happens, whether we break out beyond it or a little bit below it, and see where the support ends up lying. Now, if we look at the Dow, a little bit of a different picture again. You can see in this case, we do have a nice fresh breakout. And this is, I think, a function of that rotation that I was discussing a little bit earlier, where we have Dow names that are more tied to recovery starting to perform better. And a lot of that was due to the fact that they were underperforming throughout the last month. Now, this is probably a good sign for all three of the major indices of the four, or IWM being the one that's kind of the oddball. But this is actually a good sign that all four or all three of these indices, meaning the S&P 500, the Nasdaq, and the Dow, will continue to rally. Because the Dow Jones was the index that was kind of stalling out as far as those three are concerned, and really struggling to break to new highs. And the fact that we broke out to new highs, I think bodes well for the Nasdaq to eventually turn around and come back up with it, and for the S&P 500 to kind of continue its rally. Now, it could be that, again, the Nasdaq breaks down here, at which point I probably expect the Dow and the S&P 500 to follow suit. But overall, this is the beginnings of another strong trend. Now, again, the Dow Jones has still been holding steady for a while now. Way back in November of last year, as we started this rally, we started developing this channel, and now the form of this channel has changed significantly as we headed into the spring of this year and now into the summer. You can see that we started to accelerate and kind of reshift what the top of that channel looked like. And then we had a really broad consolidation that threatened the bottom of that channel a couple times now. And then we've been able to respect it up to now and are actually breaking out in order to maintain the strength of that channel a little bit further. I grabbed the wrong trend line there. And so, for the moment, this channel remains somewhat intact and pushing upwards. And so, it looks like, just like the S&P 500, the Dow Jones has spent enough time consolidating sideways to be able to break out, while in the bigger scheme of things, still maintaining its upward trajectory without ever really breaking through it. Which, again, is in contrast to what we saw with the Nasdaq, which actually broke its upwards channel quite a while ago. You can see back in March, we kind of broke that channel and started trading sideways for a good portion of time. And this, again, is a function of exactly that rotation that I was mentioning earlier, where tech names started to struggle while the Dow started to actually do better. And you can see that that's exactly what happened. Recovery stocks started to do much better during that period. And you can see that's when the Dow started to accelerate and get on the top of its channel, while the Nasdaq traded sideways. Now, at the moment, we're starting to see these recovery names, or the Dow names, start to pick up steam, while the Nasdaq is stalling out. But again, I don't think that we're going to see the same type of behavior where the Nasdaq starts to go sideways or down while the others go up. I think at the moment, things are tied up closely enough that we should see them move together, which means either the S&P 500 or the Dow follow the Nasdaq down, or the Nasdaq is going to follow them up. So I think of the three indices, the one I'm watching the most closely is the Nasdaq, to see how it behaves and see which way it tries to lead the other two. But like I said, right now this is still bullish. Just like the S&P 500, this is a very bullish chart. Nothing real negative other than the fact that volume isn't very high. We are beginning to get a new swing up with the moving averages, which should bode well for an extended move to the upside. So all systems go if you're a bull. That's, I think, the one thing you want to take away from this is things are looking really good. Until we see these trajectories change, until we see the S&P 500 lose that channel, we see the Dow Jones lose this channel, we see the Nasdaq fall below its moving averages, we have to assume that this rally will continue and that we just want to go ahead and benefit from trading to the long side until something changes. And it may not be for a while, considering the Fed's monetary policy and the fact that they don't want to change it. Means money has to go into the markets or has to find return somewhere else. And so until that changes, just ride this wave. Like I said, the big key is just making sure that you don't chase price action. You just go ahead and take advantage of good buying opportunities and good risk reward as these stocks set up for breakouts. Now, the one index that, of course, is not really participating is the S&P, is the Russell 2000. You can see it's been trading sideways. It's been stuck in neutral for a while. Just like the Nasdaq, it had a nice channel during the holiday season and the beginning of the year, and then it just kind of started shifting and trading sideways, and it's still stuck in mud. I think the best thing you can say about this is that it's not breaking down. It's just holding steady. It's stuck in its moving averages, and I think that this, if anything, shows us that the recovery trade is still kind of a little bit stuck, because there's a lot of energy names in the small caps, and they are maybe not doing as well as they should, even though oil had done well for a while. And so what we have here is, traders are still focused on certain areas of the market, and they're ignoring others. And so we don't have the real strong bull market that we had in the short term in November and December and January. We still have a pretty good bull market, but it's one that, like I said, there's rotation going back and forth, and it's more of a stock picker's bull market where you can't just buy blindly and expect it to go up. You need to make sure that you're picking the right areas of the market, and you're making sure that you are being disciplined in your trade setups. When a market is behaving like it was back in November and December, a lot of mistakes are erased, and a lot of trades work out, even if they weren't good trades. But when you have a market like the one we're in now, even though you have most of the indices at all-time highs, a lot of traders still struggle because it's not an index where it's not one of these kinds of rallies where everything moves together. Like I said, things are taking turns running up, and the markets are mostly just holding up at highs because the indices look well. But underneath the surface, there are names that are doing either much better or much poorer than what the market indices are doing. And so you want to make sure that you are paying attention to the back and forth and the ebb and flow that's going on underneath the surface. And like I said, right now, it's not in the momentum is not in the small caps. It has not been for a while. And frankly, this doesn't look like an inspiring chart where we're going to expect rotation back into small caps. Matter of fact, what we have here is we have one of these. We have a triangle, an ascending triangle. And what we want to see now is, of course, we want it to break above this channel, or above this moving average, the 50-day moving average, and the top of this triangle, and make its way back up to the top of the range. There is, of course, a threat that it breaks the descending trend line and breaks the 20-day, and comes back and tests the 200. So we want to see what happens here. This is another index that we want to watch, but I think right now it holds the least significance of the four. And really what we're looking for here is more than as a gauge as to what the overall markets are doing, more as a gauge to see if this is going to be some opportunity here, if momentum decides to come back into small caps, or if the small caps do break down, what happens is they hit the lows, because at that point then maybe they affect the overall markets. So that's the four major market indices in a nutshell. Like I said, the S&P 500 and the Dow Jones are both looking very bullish. The Nasdaq is looking bullish, but a little bit negative, or a little bit neutral in the very short term. And IWM is just basically neutral and doing its own thing and not really related to the other three at the moment. I think this is a stock picker's market, like I said, and one where it pays well to understand where market or where money is rotating, and trying to be ahead of the moves rather than chasing the moves that have already occurred. And so that's one of the things that I try to focus on when I'm trading, and one of the things that we look at when we do my Monday post on the Patreon page. Let's take a look at the US dollar, which actually did have some momentum recently. You can see that the US dollar had a pretty significant bounce this week, made its way back up to recent highs, and is again trying to break out from this base that it's been forming for a while now. You can see in the long term what the US dollar has done. It finally bottomed out after a pretty strong downtrend, and has been really just establishing this as a firm bottom. And now we've reached the point where it wants to start leaving this former base and start forming a new base that maybe is going to extend from about 2480 to the 2550 range on the UUP index. If we look at this, as the from the function of the euro US dollar cross. Again, this is going to be inverse for the euro. Up is good in this case, and down is good for the US dollar. So you can see the US dollar rallied versus the euro, and the euro really struggled. And again, this shows exactly what's happening. We're going to go to the weekly chart, and it's going to be an inverse of what we saw on the UUP index. But basically, the euro had a very strong rally versus the US dollar, and the US dollar has finally bottomed out while the euro is topping out. And it tried to maintain its price action above 119, but it's failing. And at this point, the euro is breaking back down and reaching its recent support level of 117. If it loses that and the US dollar continues to gain strength, we're going to make our way back to about 115. This is going to be important to watch. The US dollar right now is not affecting the markets too much, but it can be that eventually the fluctuations that we see in it are going to affect it a little bit more, and they have been affecting commodities a lot more. If we look at the US yen cross, we can see that it's kind of still just stuck in the middle. This is the one weird one where the US dollar has picked up a lot of strength, but the yen has been behaving a little bit different. Typically the yen was really weak to the US dollar. Even when the US dollar was weak, the yen was weaker. And now that the US dollar has started to pick up strength, the yen actually recently picked up a little bit of strength to kind of push back. But overall, this is still bullish, I would say, for the US dollar. We have this nice pattern here that developed, and we had this channel that ran up, and we've broken below that channel. And I think what we have here is we have a very important level that we need to see the US dollar break. And as you can see, it actually, at this point, is failing. The breakdown from this channel has become a critical spot, and so if you're looking at the yen, US dollar, you probably just shorted, and you're looking for a move back down to about 109. So this is going to be a key area for the US dollar as well. And then finally we have the US Canadian. And in this case, again, for those of you that follow these Wednesday streams, you'll know that we highlighted this as a very good trading opportunity back at the end of May and beginning of June. And it actually has worked out very well now. It finally had some pushback, and we can see that the US dollar lost a little bit of ground versus the Canadian. A lot of this is going to be a function of oil. You can see oil had a strong rally and then eventually started to pull back. And now that it finally pulled back a second time, it's beginning to find support. And so if oil bounces here, that should mean that the US Canadian pulls back further. And at this point, it looks like oil found a ceiling around 75. However, it has also found a floor around 65. And so what we should expect now is a bounce back to the moving averages and possibly back up into the mid-70s, but I doubt it gets back to 75. I think what we see here is the beginnings of a triangle forming. More likely than not, oil is going to chop back and forth between these two areas. So overall with the commodities, well, actually, before we move on, let's look at gold and silver. And you can see these were dinged pretty hard by the move in oil. By the move in the US dollar. This highlights why I've been staying away from gold and silver recently. Despite the fact that they were starting to show signs of decent trading patterns. I mentioned this last week and actually the week before. The one problem with gold and silver is that they have 24-hour cycles, yet these ETFs are only open during trading hours. And so you can expose yourself to a lot of overnight moves. And that's exactly what happened over the last week, where there was some big moves, big downward moves on gold during the weekend. And really, if you were in this trade, you couldn't do anything about it. And so now it dropped all the way down to the 160s. And it's getting a little bit of a relief bounce, but this was a big shift downwards in gold and in silver. And like I said, it's a function of the US dollar picking up some strength. And I really don't see I don't have any interest in buying these, like I've said ad nauseum for the last several months. There have been some trading opportunities in them, but I found that I've had better trading opportunities with other things like cryptocurrencies. And if we take a look at Bitcoin, we can see that Bitcoin has continued to perform well despite whatever the US dollar is doing. We had a major breakout above 40,000 and then recently above 45,000. And it looks like Bitcoin is finally kind of done with this prolonged correction that it had. Now it's probably due for a pullback soon. We are reaching a pretty good area of resistance right around 47 to maybe 50. And I don't think that we break past that right away. So I think that there's a decent chance that we get a pullback. But as long as the pullback holds above 40 to 41, I think it will be a good buying opportunity for anyone that missed any of this. And we're seeing even more strength coming out of Ethereum. Ethereum just had a major change in its structure with the London mainnet protocol passing, and it's definitely undergone some changes that make it a more bullish cryptocurrency in the future. And as you can see, it's continued to rally through that. And again, we were able to break through a key level around 28 to 29. It's above 3,000. Now, just like Bitcoin, it's probably going to be due for a pullback soon. That's going to be a trading opportunity and a buying opportunity. As long as it stays above 28.80, maybe a little bit below that, I think that it's still going to be fine. And so, it's hard to recommend the trade right now because it's up so many days in a row. What do we've got? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, maybe 22 candles, and you've got 2 or 3 red candles, right? So it's definitely starting to get overbought, which is why I'm saying it's probably due for a pullback soon. However, cryptocurrencies in general run stronger or weaker depending on which direction they're going, and they can trend for a while. But when we do get another pullback or another consolidation range, it would probably be a good buying opportunity for those that missed this. But I like this a lot more than I like gold and silver right now. And that's one of my main focuses over the last year and a half now has been in cryptocurrencies. And a lot of them are performing well, and a lot of them are giving us good moves. And a lot of us are actually starting to show signs of beginning to follow Bitcoin and Ethereum up. If you take a look at some of these smaller cryptocurrencies that I have, you can see Binance is only now starting to pick up steam and starting to follow suit. Matic is finally having a good day today. It also is breaking out off of a decent move. And if you just look across the board, even Doge is starting to pick up some steam and starting to make its way up. And so we're starting to see a lot of these smaller alt currencies follow what the major currencies, which is Bitcoin and Ethereum, have done recently. And so I think generally speaking, this is a good time to be looking at cryptocurrencies. Now again, you've missed the boat if you weren't in on some of these already. And the risk reward's not in your favor at the moment unless a couple of these are kind of lagging behind. But you want to watch these if you can. You want to look for these pullbacks because it looks like they finally have bottomed out and have turned their eyes back upwards. And so when you see pullbacks, they're probably going to be good buying opportunities as they just take a breather before they want to go ahead and try to rally further. All right, so that covers what I wanted to discuss today. If anyone in here has a chart they want me to look at, or if they have questions regarding any of this, whether you want me to dig into these cryptos a little bit more, whether it's something about oil or the markets, feel free to ask, and I'm more than happy to answer these questions and give you a better idea of what I'm looking at. Other than that, we can call it a day. So let me know. If you have a chart request, feel free to put it in the chat now. If you're watching this as a recording and you want to ask me about a chart, you can always ask me on Twitter. Just follow me at StockDarts on Twitter. You could ask on there. I'll be more than happy to send you a chart through there. Or even email me, stockdarts@gmail. I'll be more than happy to help you out there as well. Other than that, it looks like we don't have anything, so we can call it a day. I hope you guys have a good rest of this week, and we'll meet again next Wednesday.